We've got European bond markets not playing ball with the global theme that bond markets are worried about inflation. Not this morning, at least, although, of course, the longer-term story is different. But yields dropping here in Europe just a touch this morning. But Japanese yields are higher. US yields have been higher. How concerned are you about the strength of the yields that we're seeing, the weakness in bonds?
I think we've seen a lot of weakness already, but I think there's a lot more to come over the coming months. I think that the inflation data out of the US, both the CPI and PPI prints this week, kind of hammer home a point that's kind of been clear for some time, that the Strait of Hormuz is causing severe supply chain disruption. I think the energy impact has maybe been less than some people expected. We're seeing an extremely rapid releases from the Strategic Petroleum Reserve in the US, which is easing the physical situation, but that can't go on forever. And we are seeing much more kind of entrenched impacts on the kind of plastic side, the petrochemical side, farther kind of down the chain of those fossil fuels. So again, the Strait of Hormuz disruption is very much a supply chain issue, not just energy, and it's going into a hot market. It's because of the wealth effect from what's happening in stock markets, and in generally growth is okay. We're in the part of the AI cycle where people are still getting more efficiency. It's increasing demand. We're getting a massive capex boost. We're getting fiscal expenditure. So we are getting a real big supply side shock into inflation in an economy that's already got very strong demand at inflation. And I think that people are not fully registering how bad this could be later on this year.
But later on this year. In the meantime, just get ready to buy the dip, right?
I think, sadly, yeah, for the moment, from stocks, I think so. I think what's really important is that you got to change the different time spans. The AI bubble will end in tears, but not until the earnings rug pull that happens at some point when they realize they're all competing for the same space and they're all claiming to project just immense earnings, which is way more than the earnings of the companies they're supposedly supplying services to. So it can't sustain. But I don't think it happens until we get that earnings rug pull. And I don't think that happens now for another quarter, because we just got through this earnings season. Another quarter at least. So I think we've still got months more of that big bubble. And I think in the interim, yes, ultimately dips are to be bought, but the dips will get bigger. Now, I do think we're probably going to continue to rally in the short term, as we've talked the last couple of weeks, until we get through this Trump-Xi summit, assuming there's no tail risk there. I think once we get through that, we'll return focus to the Strait of Hormuz, the fact there's no resolution, and I think that will cause quite a nasty swoon. And because the pace of gains and the herding we've seen, that swoon will be really, really powerful, but it'll still leave stocks immensely up than where they were only a few months ago.
Just very briefly, do you expect catalyst to the upside from Trump and Xi?
No, I expect it to be upside only because relief. I expect, if they don't deliver... Sorry, I do think there'll be some positive headlines. There's my base case, some positive headlines, but I don't think they'll be dramatic. And I think we're kind of expecting those platitudes. Like, I've had a beautiful talk and they have a wonderful relationship, and there's a bit of buying of soybeans, and there's maybe some chip deals at the margin, but none of them are going to be game changing. I think it'll be more about relief if there are no tail risks. So positive in that regard, but not a major bullish catalyst.